Something big is happening in the global economy right now, and most people don't realize how serious it is. Some experts are quietly warning that what we are seeing could be worse than 2008. You might remember the fear that spread across America during the last financial crisis. But this time, the warning signs are appearing faster and in more places at once. Before we go deeper, make sure you subscribe to WorldScope News so you never miss the stories that mainstream headlines often overlook. Staying informed today could make a huge difference tomorrow. Right now, markets look calm on the surface, but beneath that calm, pressure is building. And history shows us that financial storms often arrive when people feel the most comfortable. Back in 2008, the collapse didn't happen overnight. It started with small cracks that most people ignored. Today, those same kinds of cracks are showing up again, but in a much more connected global economy. That means any shock could spread faster than ever before. One of the biggest warning signs is rising debt across households, corporations, and governments. When debt grows too fast, the system becomes extremely fragile. In the United States, credit card balances have been climbing to record levels. At the same time, savings for many families are shrinking. This creates a dangerous combination that economists are watching very closely. Because when consumers pull back spending, the entire economy can slow down quickly. Another red flag is the pressure on banks and financial institutions. We've already seen moments where confidence started to shake. During the 2008 crisis, the failure of Lehman Brothers sent shockwaves across the world. Today, experts worry that similar domino effects could happen again. But this time, the risks are more complex and more global. Financial systems are now deeply interconnected across countries. Interest rates have also risen sharply after years of being extremely low. That sudden shift is putting stress on businesses and homeowners alike. Many companies borrowed heavily when money was cheap. Now they must refinance at much higher costs. This squeeze is quietly building pressure inside the corporate world. And when pressure builds too long, something usually gives. Housing is another area flashing warning signals. Home prices surged rapidly, and affordability has become a serious issue for many Americans. When fewer people can afford homes, demand begins to cool. And cooling housing markets have historically led to broader economic slowdowns. At the same time, commercial real estate is facing its own storm. Office buildings in many cities remain half empty, even years after the pandemic. This creates huge financial risks for lenders and investors. Some analysts believe this sector alone could trigger wider trouble. Meanwhile, the stock market continues to show mixed signals. Big tech may look strong, but the broader market tells a more cautious story. Volatility has been creeping back into trading patterns, and seasoned investors know volatility often appears before major shifts. Even the Federal Reserve has admitted uncertainty about the road ahead. Their policy moves are being watched minute by minute. When central banks sound cautious, markets usually listen carefully, because they often see risks forming before the public does. Global tensions are adding another layer of uncertainty. Economic stability becomes harder when geopolitical risks rise. Supply chains, which were already fragile, still haven't fully recovered. Any new disruption could quickly push prices higher again. Inflation may have cooled from its peak, but it hasn't disappeared, and stubborn inflation limits how much support policymakers can provide. This puts leaders in a very difficult position. They must fight inflation while also trying to avoid recession. History shows that balancing act rarely goes perfectly. Mistakes, even small ones, can have huge consequences. Consumer confidence surveys are starting to show cracks. When people feel uncertain, they naturally spend less. Less spending means slower business growth, and slower growth often leads to layoffs. Layoffs, once they begin, can spread faster than expected. We've already seen early signs in certain industries. Tech companies, once seen as unstoppable, have announced waves of job cuts. That shift alone has caught many analysts off guard. Small businesses are also reporting tighter profit margins. Rising costs are squeezing them from every direction. When small businesses struggle, local economies feel it first, but eventually the effects can ripple nationwide. Another major concern is government debt levels. The United States is carrying historically high obligations. Servicing that debt becomes more expensive as interest rates rise. That limits flexibility during future crises. In 2008, policymakers had more room to respond aggressively. Today, that room may be much smaller. Financial markets are extremely sensitive right now. Even minor surprises can trigger sharp reactions. We've already seen sudden market drops followed by quick rebounds. That kind of instability often signals deeper uncertainty. Wall Street insiders are quietly hedging their bets. When professionals get defensive, it's usually for a reason. The famous street known as Wall Street often reacts before Main Street feels the impact. By the time everyday families notice, the shift is usually well underway. Another worrying trend is the rise in delinquencies on loans. More borrowers are starting to fall behind on payments. This is especially visible in auto loans and credit cards. These are often early indicators of financial stress. Banks are increasing their loan loss reserves. That means they are preparing for potential trouble ahead. Preparation like this doesn't happen randomly. It usually reflects real concern inside the financial system. Even the U.S. Treasury Department has warned about long-term fiscal pressures. Those warnings rarely get enough public attention. At the same time, global growth forecasts are being revised downward. Slower growth worldwide can quickly affect the U.S. economy. Remember, the world is far more connected than it was in 2008. Problems in one region can spread within days, not months. Energy markets remain another wild card. Sudden spikes in oil prices could quickly reignite inflation. If inflation surges again, interest rates could stay higher for longer. That would add even more pressure to borrowers. Many Americans are already feeling financially stretched. Rising living costs have eaten into household budgets. Credit usage is rising partly because people are trying to maintain their lifestyles, but that strategy can only work for so long. Eventually, higher debt payments begin to bite, and when they do, spending often drops sharply. Market veterans often say crises don't repeat exactly, but they rhyme. The current environment has several familiar echoes. Still, there are also important differences this time, and some of those differences could make the situation more unpredictable. For example, algorithmic trading now dominates large parts of the market. That can accelerate both rallies and crashes. Speed in modern markets is far greater than in 2008. Moves that once took days can now happen in minutes. Social media also spreads financial panic faster than ever. Fear can go viral in a matter of hours. At the same time, policymakers are more experienced than they were before. They have studied the last crisis very carefully. But experience does not guarantee perfect outcomes. Every economic cycle brings new surprises. Investors are closely watching upcoming economic data releases. Each report has the potential to shift market expectations. Bond markets, in particular, have been flashing warning signals. Historically, bond markets often predict recessions early. Yield curve movements have already raised eyebrows among economists, and these signals are not being ignored. Some analysts remain optimistic about a soft landing. Others warn the risks are still heavily tilted downward. The truth is, uncertainty is extremely high right now, and uncertainty is exactly what markets dislike most. If you're still watching, drop a comment below and tell us, do you think we're heading toward another major financial crisis? Your perspective helps this community stay sharp. Financial resilience starts with awareness. The more informed people are, the better decisions they can make. That's one reason conversations like this matter so much. Silence and complacency are often the biggest risks. The coming months will likely reveal much more about the true direction of the economy. Key indicators are approaching critical levels. Investors, businesses, and policymakers are all watching closely. The margin for error is becoming thinner. No one can predict the exact timing of major downturns, but history shows warning signs often appear well in advance. Right now, many of those warning signs are flashing simultaneously. That's what has experts paying such close attention. Still, it's important to avoid panic. Awareness and preparation are far more useful than fear. Economic cycles are a normal part of financial history. The key question is always about severity and timing. Some sectors of the economy remain surprisingly strong. Labor markets, for example, have shown resilience, but even strong job markets can weaken quickly if growth slows. Momentum can shift faster than most people expect. Corporate earnings forecasts are another area to watch. Forward guidance often reveals hidden stress. If companies begin lowering expectations broadly, markets usually react. That moment can come suddenly. Liquidity conditions in the financial system are also tightening. Less liquidity typically means more market volatility. Volatility itself isn't always bad, but sudden spikes often signal underlying instability. Smart investors are focusing more on risk management right now. Preservation of capital becomes critical in uncertain times. Diversification strategies are gaining renewed attention. People are remembering old lessons from past downturns. The psychological side of markets is also very powerful. Fear and greed continue to drive major swings. Right now, sentiment appears cautiously nervous. That middle ground can shift quickly in either direction. Economic data over the next few quarters will be crucial. Each report will either calm fears or amplify them. Many households are already adjusting their spending habits. Subtle behavior changes often appear before official data confirms trends. Retail sales patterns are showing uneven momentum. Some categories remain strong while others are weakening. This mixed picture makes forecasting extremely challenging. Even top economists admit visibility is limited. What we do know is that financial systems tend to move in cycles, and late cycle dynamics often look exactly like this. If risks continue building, markets could face a sharp reset. If conditions stabilize, the economy could still navigate safely. That uncertainty is why this moment feels historic. We are watching the setup phase unfold in real time. Stay alert, stay informed, and keep asking smart questions. The next chapter of the global economy is being written right now. If you found this breakdown valuable, share this video with someone who follows the economy closely. Smart information spreads best when viewers like you pass it forward. And don't forget to subscribe to WorldScope News for clear, simple updates that keep you ahead of the curve. We'll be watching every signal so you don't have to. Thanks for watching, and stay prepared for what comes next.